Hello, I'm Dami Coker, and thank you for joining us for this webinar. I'm joined today by Felix Goltz, Research Director at Scientific Beta, who is going to tell us more about inconsistent factor indices and the risks of index changes. Hello, Felix. Thanks for joining us.
Hello.
So frequent changes in the index methodology is quite a common occurrence in the smart beta industry. Transparency on changes in index offerings and methodologies is crucial because it allows investors to evaluate the quality of different index offerings. Okay, Felix, so can you just start by giving us some more insight on this? Why do index changes occur, and what are the risks of too many index changes for investors when it comes to smart beta indices?
Yeah, so it's useful to recall the general properties of these factor indices. So a key advantage that investors perceive is that indices are entirely systematic. So you don't rely on discretionary decisions of, say, an active manager, but instead you actually have a set of rules. So these rules are typically transparent and they describe how the index is constructed. And this systematic nature of these indices, of course, gives investors a form of predictability. So they know what the objective of the index is, they know what the construction principles are, they know what the target exposures, in terms of factor exposures, for example, are of such an index. And this is typically seen as a desirable property. Now, index providers, of course, try to innovate. And so even though at any point in time the rules of an index will be systematic, there could be changes to the set of indices. So these could be new indices, for example, that a provider launches, or it could be that the rules of an existing index change. And we actually see that these changes are quite frequent. So investors are sometimes surprised to see that index providers really come up with new indices very, very frequently and quite often replace existing indices by new indices that are supposed to lead to better results. And so these could be, again, changes to existing indices, or they could be new indices. But of course, if the provider communicates essentially on a new index, say in the area of value indices, and actually puts less emphasis on the existing indices, then we can see that there could be a problem of inconsistency over time. So the representation of what, say, the value factor is and how a value index should be constructed could actually change over time. Now, investors sometimes criticize this, and they say that index providers really start to resemble to active management houses, and active management houses sometimes are criticized for having a wide range of actively managed funds, and that means they can always select a fund that at any point in time actually has shown attractive performance over the recent period. So we have this problem that is described of cherry picking when you have large active management fund houses that actually have a wide offering. And so when you think about factor indices and smart beta indices, they are supposed to offer an alternative to more discretionary active management. But here, investors sometimes complain that index providers start to look a little bit like active management houses, in the sense that they have so many different indices and they can always create new indices. So that, of course, would also allow them to always cherry pick and always find an index which they can show to their clients, which actually has quite attractive performance. So there is a problem with changes in indices, with changes in index offerings, which investors perceive clearly. On the other hand, of course, it's unreasonable to say that there should be no innovation. So there may be quite legitimate reasons from index providers to actually change their methodologies, to launch new indices. And so what we'll try to do here is really try to give some insights and discuss the problems with frequent changes and inconsistencies over time, but also the kind of safeguards that investors could use, and what would be useful elements for investors to actually protect against some of the risks with frequent changes. Okay,
so let's delve into that a little bit more now. You mentioned that index providers might be cherry picking. So for investors, what exactly do these inconsistencies mean? What may they notice that's different in new index offerings each time?
Yeah, so there are essentially two problems that investors face in terms of the consequences of inconsistencies. So a first risk is simply a data mining risk. And a second type of risk that investors face has to do with long-term investing. So institutional investors in particular typically have quite a long-term investment horizon, and you can argue that frequent changes to the definition of an index strategy are actually inconsistent with maintaining a long-term investment horizon. So I'll just address these 2 points briefly. First, on the data mining risk. So the issue here essentially is a problem of too much flexibility. Okay, of course, if an index provider has a large degree of liberty in terms of defining new index offerings, this also means that the index provider can always exploit the data to show backtest performance of indices that can be improved. So this is a problem that has been described quite widely. The problem typically is that researchers can actually run many different specifications of a strategy, and so it's always possible over a given data set to come up with a strategy that shows very pronounced outperformance. But the question then is, well, is that outperformance actually going to last? And if you really run analysis that essentially overfits the data, you're actually seeking out patterns that are simply specific to the sample, then there's no reason why those results should actually be reliable. Now, that problem exists with any kind of backtest, but of course this problem increases when index providers have the flexibility to always change their offering, right? So if you run a backtest and launch an index, well, 1 year later you can again run a different backtest that will then be able to take into account whatever happened in those 12 months and probably fit the data better. Now that's something that is going to lead to inflated performance in the backtests. In addition, of course, you can think of an ability of the index provider to always pick the index that currently has the best performance, say, over the past 3 years or over the past 5 years, and then frequently change the index that the index provider emphasizes in his marketing, in his offerings. And so frequent changes really increase this risk of data mining. And there's different aspects of this data mining risk. So a first risk that has been described is the so-called factor fishing risk. So in the area of factor indices and multi-factor indices, we need to settle on definitions of a given factor. So the momentum factor, say, is typically defined by returns that a stock had over the past year, roughly. And so that's the standard definition of a momentum factor. You can, of course, vary these definitions by making adjustments to exactly how you measure returns, what kind of adjustments you make for, let's say, sector effects, country effects, maybe for certain risk exposures. And so once you use, for example, some kind of residual momentum instead of the standard momentum, you have a large number of variations that you could test, and so you have a risk of factor fishing. You can always come up with some better definition of a factor that fits the sample better, but may not actually be reliable. Of course, when you talk about multi-factor indices, there's not only the factor definitions. These are the starting point, really. What are the factors that you include? How do you define those factors? You have an additional risk when you define the portfolio construction approach. So when it comes to implementing a multi-factor index, and even if you stay with, let's say, a given set of factors and a given definition for these factors, you still have a lot of portfolio construction steps to define. Okay, so how do you neutralize certain risks, for example? How do you attribute weights to stocks? How do you allocate across the factors? These are portfolio construction decisions which an index will have to make. And here again, you can use this flexibility to come up with a different model of portfolio construction, if you will, each year, and an index provider could always find something that shows better results in a backtest. So there's a very basic argument on this data mining risk, and that basically says if we want to avoid taking too much data mining risk, we cannot have 100% flexibility. Okay, we need to put some constraint on the number of variations that we can actually test. So there's an interesting paper by Andrew Lowe published in the 90s, basically analyzing this problem already. There were probably less multi-factor indices out there at that point, but of course the basic problem was already there, that financial analysts would use the same data set to come up with strategies that generate outperformance, and you end up with the risk of finding false results that are simply due to the sample and will not hold more generally. And so the basic argument is you have to have a framework, and that framework will actually limit your number of choices. So if you act within a consistent framework, say of how you construct portfolios, how you define factors, then you will have a limited number of variations that you can run, and so you will also reduce that risk of really overfitting the strategy to a given sample. So having a certain framework actually gives you a discipline, and that discipline is important. So obviously, if we think about inconsistencies over time, these inconsistencies really arise if you have a lack of framework. If you don't have a clear framework, you can generate a new index every month. If you have a clear framework of how indices are designed, you will have a limited number of options and choices that would allow you to actually design different indices. So a crucial point is really to try to avoid data mining risk, and again, being very flexible and changing indices at each point in time and very frequently will actually increase the data mining risk that investors face. A second problem, which is much more basic probably, is that frequent changes are obviously in conflict with long-term investing. So investors actually are quite careful to try to achieve long-term goals, and they really make some effort to really make sure that they keep in mind the long term. They stay with their strategy that they have defined over the long term. If you think about institutional investors, pension funds, endowments, they actually have a common approach, which is to define a set of investment beliefs. And so these investment beliefs are really some rules and some principles that the investment management team at such an organization really believes to be true and is actually committed to stick to over the long term. So this could be beliefs about say the value of diversification. These could be beliefs about which factors are actually rewarded. And so these investment beliefs are exactly meant to not be a victim of always looking for the most recent investment fads, because if you always change your strategy, that obviously means that you don't have a strategy. You're just going to adapt your investment policy to whatever current fads and fashions come up. So investors actually are quite careful about managing this risk, and so it would be quite disappointing if index providers then compromise this effort by making frequent changes to indices. It has also been shown that any kind of frequent changes that investors actually undertake in their portfolio typically doesn't add any value. So there's a large literature basically arguing that investors are better off sticking to a long-term strategy as opposed to adjusting their portfolio allocation very frequently, which quite often will expose them to return chasing and will actually lower their performance in the long term. So there's an obvious mismatch between ad hoc adjustments that occur very frequently and the objective of long-term investing. And if you think about factors, it's very clear that investors seek to target certain factors like value and momentum, because precisely they may believe that these factors carry a long-term reward. So if you want to adjust your exposure to things like value and momentum today, well, this is only because you think that these factors are going to matter over the long term. So if you accept that your provider may change the definition of that index or of that factor in 6 months, then it's basically pointless to try to target a given exposure to that factor if it's not valid in the longer term. So there's a conflict with long-term investment principles.
Okay, great. So we need to look out the inconsistencies we see are essentially data mining risk and the conflict with long-term investment objectives. Now let's look more particularly in the industry. What are the problems that then arise from these inconsistencies in terms of performance for investors?
Yeah, so there are a number of problems, and I think it's interesting first to just show what kind of inconsistency arise. So in very concrete terms, we can actually identify 3 different areas where index providers quite frequently make changes to the indices that they emphasize. So a first topic is really the factor menu. So if you have a multi-factor index, which are the factors that are included? So this can change quite frequently over time. A second area where providers make changes is the definition of these factors. So we already mentioned it, but even if you stay with an index that is supposed to give a value exposure, providers quite frequently change how they define value. So it could be different valuation metrics that change over time. It could be different combinations, and the combinations actually change over time. So there's changes in the definition of a given factor. And the third point, which is important, is changes in the portfolio construction method. So in all these three areas, providers quite frequently make changes. And I'll just show some stylized examples that shows the impact that this kind of change can actually have. So you may think that changing slightly the set of factors that is being used may not have a dramatic consequence. Well, actually, that's not true. Even if you stay with relatively similar factors, just making slight changes on which factors you include in a multi-factor index will give quite dramatic differences in performance. And again, what this means is that this flexibility that providers have can actually be used to dramatically increase performance in the backtest. And so this could lead to quite dramatic overstatements of backtested performance. So let's look at some numbers. What we show here is performance for different multi-factor indices. So all these indices simply select from a factor menu of 6 factors. So these are 6 standard equity factors. And what we show here is just the range of outcomes that you get in terms of the information ratio when you select 3 or more of these 6 factors. Okay, so we do all possible combinations of a 3-factor index that selects among the 6 factors. Then we do all possible combinations of a 4-factor index that selects among these 6, and so forth. So just note that the starting point is a fixed menu of 6 factors. And so, the kind of variation that we get is still probably relatively mild in this example compared to what you could get in practice, where you could select, probably from hundreds of factors if that's what you wanted to do. So here we're just selecting from 6. But even staying with a fixed set of 6 factors, we can see dramatic differences in the performance that you get. So if you look over the 40-year period here, for example, that's the bottom line that is shown, you can see that some of these combinations only lead to an information ratio of about 0.11. That's the worst possible outcome. If you look at the best possible outcome, you have an information ratio of 0.81. So you can see that over the long term, while still, whatever your selection of factors, you're going to get positive performance. That's in line with the historical evidence for these 6 factors. But you do get still a lot of variation. So by selecting kind of the winning combination, you could actually show much better performance. And of course, you can select the winning combination with hindsight if your objective is to show high performance. Now, what happens when you look at shorter time periods? When you look at shorter time periods, of course, these differences become much wider. So if you look at the most recent 10-year period, for example, so starting in 2008, you look at the next 10 years, you can see that the combination of factors that had the lowest performance actually had a negative return relative to the cap-weighted index. So you can see that you would actually have generated underperformance with, say, the wrong factor selection. With the best factor selection, you would have a very attractive Sharpe ratio of information ratio of 0.75. So again, you can see this difference between actually underperformance and very strong outperformance with a Sharpe ratio of 0.75 by simply changing the factors that you select. Of course, the risk here is that with hindsight, you can always make a factor selection that has a very attractive information ratio, but that's unlikely to actually repeat in the future. So what you see here is over any given 10-year period, you can generate very dramatic differences in performance by selecting the best combination of these 6 factors. So the question then is, of course, if you do this exercise and you actually select simply based on past performance, what happens then going forward? So just to illustrate this, we looked here at really a simple exercise where we just select the winning combination, and then we're going to hold that winning combination over different horizons. So say 3 years, 2 years, 1 year. We're comparing the results of this kind of multi-factor index that always tries to pick the winning combination of 3 or more factors with a simple diversified allocation to all of the 6 factors. And what you can see here is that even though you can generate dramatic improvements, if you will, in sample, by deciding ex post what the best combination was, you actually don't get any improvements going forward. So if I select based on 10-year performance and I'm holding my winning combination over the next 3 years, we can see here that the Sharpe ratio, for example, is 0.6. That compares to a Sharpe ratio of 0.68 for the simple diversified allocation to all 6 factors. So kind of chasing the best performing factors will allow me to show impressive performance in the backtest, but it will not actually lead to any improvements out of sample. Now, what we also looked at here is what is the kind of overstatement of the backtest that you get. So we're comparing the improvement relative to the 6-factor diversified index that we get in the 10-year period that we use to kind of conduct the backtest, and we compare this to the actual out-of-sample period. So what do we get over the next 3 years? So here you can see an impact on performance of -3%. So what this means is that the actual performance that we achieve after selecting the winning factors is actually 3% lower than what the backtest suggests. So this clearly shows that chasing the winning factors will actually inflate performance and will show performance that is actually not in line with what investors should expect. So again, we need to be careful when selecting quite flexibly among some of the factors in the factor menu. And this, again, I will show some examples, is a common risk with multi-factor index offerings. A second type of risk that investors face is the risk of changing factor definitions. So let's say we stay with a given factor, and here I'm looking at the value factor. What is the kind of flexibility that index providers have? Well, the flexibility is that index providers can choose different ratios to actually capture this idea of low valuation stocks, and they can combine these ratios in different ways. So I'm just showing here an example of an index provider that actually calculates different kind of value scores and different kinds of value indices, and I'm just showing the actual definitions that are in use. So you can see that over time there are quite different definitions of the value factor that come up. And of course the question is, what is really the guiding principle behind these differences in definition? It is quite obvious that when you make quite arbitrary changes in the definition, you can come up with, again, a large number of variations, and so this could always be used to show improvements in performance. But the question, of course, is whether these improvements could actually be achieved outside the backtest. So if you look at a current definition that is used in 2018, you can see that there's 3 variables, things like price to book, also the long-term reversal, the earnings yield. You can see that these variables are actually weighted with different emphasis. So you have a 30% weight on one variable, a 60% weight on another variable. So of course, looking at these kind of weightings, you can again see that there could be a large number of possible variations. Okay, I could also equal weight the different variables. I could emphasize them differently. So as soon as I allocate weights to these different variables, I have a large number of possible variations that I could test. And finally, you can see that there's different adjustments in terms of conducting the scoring relative to a sectors. And the most recent definition here that we mentioned, there is actually no adjustment for the sector that a stock belongs to. In the earlier, in a version that was released earlier of a factor index, there is a sector relative scoring. The valuation metrics that are used are different. And so this, of course, what this does is that it increases the flexibility that a provider has. And if you just look at these different possibilities, there's 4 possibilities here. But you could just think about different adjustments that you could make by combining variables differently or using other variables, and we could easily come up with probably hundreds of variations of such factor definitions. Now the risk here is again a risk of data mining. So once you have unlimited flexibility, you have to be careful that backtest results, of course, could be biased by the amount of flexibility that you have, and we just illustrate that here with a simple exercise. What we're doing here is we're just picking the best value definition among 10 different variables. So we're looking at things like book to price, earnings to price, sales to price. several valuation metrics, and we're just selecting the variable that has the best performance in the backtest. We're looking at a 5-year period, and we're comparing that to a consensual definition of the value factor, which is the book-to-market ratio, which is the most widely used in the literature. And we can see that in the backtest results, we actually get an improvement in performance of about 1.5%. So that's the first part of the graph. Then we look at what happens after forming the portfolios. So when we lose the benefit of hindsight, well, then we actually get an underperformance of 2.5% relative to the standard value definition. And so what you can see quite clearly is that you get a very pronounced kind of overstatement of the backtest results, because actually out-of-sample performance is 4% lower than the performance that you've shown in the backtest. So the risk that is really inherent in these frequent index changes is that you could load up on these data mining risks. And so we've discussed selecting from a menu of factors. We've discussed the kind of definitions that are used to define each factor. Now there's a final issue that is worth noting, and that's the portfolio construction that we apply to actually design these indices. So also in the area of portfolio construction, there is a lot of choice. So even for a given selection of factors and for given definitions, indices could lead to quite different results. So one area of concern in particular is the difference between a bottom-up portfolio construction and a top-down portfolio construction. The bottom-up portfolio construction builds portfolios really in one step, looking at the stock level scores and then trying to weight securities by a composite measure of factor scores across multiple factors. The top-down approach, on the other hand, constructs first single-factor portfolios and then combines them to form a multi-factor allocation. Now, these differences may seem technical, but actually what you have behind these differences is different investment beliefs. So if you have a strict belief that factor scores have a very tight and precise link with returns of stocks, then of course you should favor a bottom-up approach, because that allows you to control the factor exposures more precisely and really seek out the combination of stocks that leads to the highest factor intensity at the overall multi-factor level. The top-down approach reflects investment beliefs that say that, well, basically diversification is very relevant. Explicit allocation to different factors is also relevant. And the link between factor scores on the one hand and expected returns on stocks on the other hand, holds in broad strokes, but is not entirely precise. And so we should avoid kind of overusing the information at the single stock level. So since these approaches rely on quite different investment beliefs, it would be surprising that, say, a given provider or a given research team, first launches one of these approaches, then launches another approach. But this is indeed the kind of change that we actually see in the industry.
Okay, and now let's look at the specifics in terms of performance. How do these index changes actually affect performance? Do you have some practical examples of what commercial providers might be offering?
Yeah, so we showed some examples so far, which I admit are highly stylized examples. So these were not real-world portfolios. We just try to control portfolio construction and then just change one parameter, if you will. So say the selection of factors from the factor menu as one example. In practice, of course, these three different issues could be changed by a provider in one occurrence. So if a provider has a multi-factor index, he could come up with a new multi-factor index that has perhaps slight variations in terms of the factors that are included, but also the factor definitions and also the portfolio construction approaches. And of course, thinking about flexibility, we would expect that varying different parameters at the same time to come up with a new index could lead to very pronounced differences in performance. And I'll just try to give you one concrete example of an index change that happened in the industry. Again, there's probably lots of examples that you could find. So just as a case study, I'd just like to focus on some of the differences between two multi-factor indices that were launched by the same provider and the impact that this has on performance. Because again, you could think that if you have a multi-factor index on broadly similar factors, maybe performance differences are no big deal, and maybe we shouldn't be too worried about the effect that these changes could have. But we'll show that differences can really be quite substantial. So the case we're taking here is a case of indices launched by index provider MSCI. So this was an evolution of the offering in 2015. So what happened here is that there was something called the Quality Mix Index. So that index was launched in 2013, and that gives a combination of three factors: value, low volatility, and quality. And this index is also constructed in top-down framework. What happened then in 2015 was that there was an additional multi-factor index that was launched and heavily emphasized by the provider, and that multi-factor index targets exposures to 4 factors. So you could see that some of the factors are the same. Value and quality, for example, are included in both factors. But also now there's exposure to momentum and size factors, and there is no target of a low volatility approach. Interestingly, also, this index is designed in a bottom-up portfolio construction framework. And so it's really interesting to look at what differences we get between the two indices. Again, if you think that both of these capture the broad idea of getting exposure to rewarded factors, you could expect them to behave quite similarly. But we'll see that there are quite pronounced differences both in terms of the factor exposures and also in terms of the performance, which are quite interesting. So in terms of the factor exposures, we have an overview here of the exposures to a set of 6 factors of these two indices. So QMX denotes the Quality Mix Index, and then DMF is the Diversified Multi-Factor Index. So we assess the exposures here to 6 factors, and we see quite interesting differences. So some of the differences may be expected from the description, but some of the differences are also more surprising. So what we can see, for example, is that momentum and size, which are not explicitly targeted by QMX, actually have much lower exposure in QMX than what they have in the DMF index. So you could argue, well, that's in line with what the index is targeting, so that may not be a big surprise. But you also see some examples like the value exposure. So you can see here that the value exposure is actually substantially higher for the DMF index than it is for the QMX index. And this could seem surprising because value is actually included in both of these indices. Actually, in the QMX, it's one of the 3 factors. In DMF, it's one of the 4 factors. So, there's perhaps no strong reason to expect that the value exposure in DMF is actually, multiple times higher than what it is in QMX. You can also see that on the exposure to the quality factors, so things like investment and profitability. You can see here that in terms of profitability, for example, it's actually the QMX that has a higher exposure to profitability than DMF. And so you can see that even in terms of the factors that are common to both of the indices, in terms of their target factors, you see quite pronounced differences. Now, what about performance of these different indices? So an interesting question here is really, well, what was the performance before the new index was launched? And what is actually the performance after the new index was launched? So, of course, there could be multiple reasons why a provider launches a new index. But an interesting question, of course, is, well, what did the performance of the index look like when it was launched? So this was, of course, backtested performance. And how does that compare to the performance of the index that had been live already at this stage? And so here what you see on the left-hand side is a comparison just of the relative returns relative to the cap-weighted index of the, if you will, the new index and the old index. So DMF was newly launched, and before its launch, it actually showed a relative return of about 2.5%. Compare this to QMX. So QMX was live during this period and only had an outperformance of about half a percent. So you can see that in the period, since the live date of the old index up to the live date of the new index, there was substantial improvement in the performance of the new index. Then the next question is, what happened after the new index was launched? Well, if you look at the results up to the end of last year, after the index was launched, you can see that actually the performance of the new index DMF was actually flat. There was close to 0% difference with the cap-weighted index, whereas actually the old index had had much higher returns over that period. Again, of course, we don't exactly know for what reasons the provider launched the new index, but you can clearly see from this illustration that looking at the backtest performance of a new index when it is launched and comparing that with older indices, may give you a result, but it's not sure that that result will actually hold after the index has been launched.
Great, thank you for that example. So we've gone over the inconsistencies for investors and what the inconsistencies are that exist in the industry, as well as a case study. So to conclude, please just remind our viewers who are watching why it's important that they are aware of the risks of index changes.
Yeah, so the key idea really is that, of course, index changes can occur. Providers may have, very good reasons to innovate. They may simply want to improve the implementation of their indices. And here there's no big difference between smart beta or factor indices on the one hand and cap-weighted indices, for example. So even in cap-weighted indices, we see methodology changes. So at some stage, providers started to include free float adjustments, for example, which wasn't there in older versions of the indices. Providers also changed the country classification. They may change all kind of rules that they use in the index, and they may do that for good reasons. But also, I think we've seen that there is a risk that inconsistency over time just introduces a lot of flexibility. And again, you can go back to this idea of cherry picking. So if active managers want to cherry pick and always emphasize a fund in their range that had good performance, well, at least they have a lot of constraints with doing that. So there are reporting standards, for example. So there are things like the GIPS, the Global Investment Performance Standards, that will actually avoid this kind of practices. So of course, for index providers, we don't have similar standards that would actually prevent index providers from always emphasizing an index that may have worked very well in the recent period, either by picking one from the large menu that they have or just by creating a new one which they could best fit to the data at hand. So there is a risk that this backtest performance that investors are shown may not be reliable, and that risk always exists, but it just increases when you have a lot of flexibility. And I think inconsistency over time just really opens the door to a lot of flexibility. Having a lot of changes over time, of course, is also inconsistent with long-term investing. And I think it's interesting here to cite Warren Buffett, who is, of course, a strong believer in adhering to one's investment principles and to staying the course with one's strategies over time. And so he basically said that the stock market is quite efficient in transferring wealth from those who are impatient to those who are patient. And we think precisely the risk with index changes that are too frequent is that you're allowing for too much impatience to express itself.
Okay, I think that's a great quote to wrap things up. So thank you for your time, Felix. And I think that concludes our webinar today. So our thanks to Felix for sharing Scientific Beta's research on the topic. For more information, please consult our white paper, which is available on our website, www.scientificbeta.com. And if you have any questions, please send them to webinar@scientificbeta, and we will get back to you as soon as we can. Lastly, please follow us on social media. We are present on LinkedIn, Twitter, and YouTube. So thank you for watching today, and goodbye.